When the stakes are high, the smartest investors never walk alone. You've heard the success stories. Investors who made fortunes during crises, CEOs who bet big and won, billionaires who avoided disaster while others collapsed. What's their secret in almost every case? There was a risk consultant behind the curtain, someone running simulations, spotting hidden threats, designing protections before disaster could even strike. Today you're going to learn what risk consulting really is, why top investors rely on it, and how you, no matter your portfolio size, can start thinking like the elite. Let's begin. Most investors don't manage risk, they just hope for the best. They chase returns without hedging exposure. They rely on instinct instead of structured analysis. They read charts, but not contracts. They diversify portfolios, but not decision-making logic, and that's dangerous. Because the markets don't reward bravery. They reward calculated resilience. When you invest without real risk analysis, you're flying blind through a storm. And when the storm hits, it's not just your profits that disappear, it's your confidence, your reputation, your future. That's why serious investors don't just ask, what's the upside? They ask, what's the risk and how do we control it? So what exactly does a risk consultant do? Risk consultants are not financial advisors. They don't tell you what to buy or sell. They build the strategic safety net behind every major move. They operate in 3 stages. First, they reveal invisible risks. They uncover what most investors don't even think about. Legal vulnerabilities, regulatory red flags, macro sensitivity, operational fragility, reputation exposure. They don't guess. They investigate. Second, they model the downside. What if the market crashes? What if your counterparty defaults? What if interest rates surge? What if a deal gets delayed? They run scenario simulations, apply probability, quantify the damage. They use tools like value at risk, stress testing, and sensitivity analysis. They don't just say, this could go wrong. They show you exactly how, why, and how bad it can get. Third, they create protection strategies, hedging through options, rewriting deal terms, layering insurance, structuring fail-safes, designing contingency plans. It's not about playing small. It's about protecting your big plays from becoming big mistakes. Before we go deeper, if you're the kind of investor who wants to protect wealth, not gamble with it, subscribe to Investor School now. This is where the real strategies live, the ones billionaires use, but rarely talk about. Click subscribe, and let's move forward. Let's pull back the curtain even more. Where exactly do risk consultants operate? In family offices, they monitor global exposure, currency risks in Asia, regulatory shifts in Europe, and economic instability in emerging markets. They help protect generational wealth. Quietly, in private equity, they assess every deal before it's signed. They dig into legal structure, reputational risk, environmental liabilities, and hidden debt. They save millions before the ink dries. In crypto and tech, they build frameworks around volatility. They help structure protocols for exit timing, data risk, and compliance under pressure. The more volatile the environment, the more valuable risk consulting becomes. And here's the key insight. You don't have to be a billionaire to use them. Today, risk consultants are hired on for due diligence, asset reviews, and strategic audits. This is no longer a luxury, it's survival logic. So how can you, as an investor, start applying this mindset today? First, ask the right questions. Where am I exposed? What am I not seeing? What would happen if everything went wrong? That alone puts you ahead of most investors. Second, bring in an outside lens. Even the sharpest investors have blind spots. Sometimes, a second opinion can save years of regret. Top firms bring in risk consultants not because they're weak, but because they're smart enough to know what they don't know. Third, think in probabilities, not possibilities. Bad investors ask, could this happen? Great investors ask, how likely is it and how bad would it be? They work with probabilities, outcomes, exposure limits, and mitigation strategies. It's not about being fearful, it's about being deliberate. Here's the final truth. Risk is not the enemy of wealth. Unmanaged risk is the difference between the average investor and the elite investor is not intelligence, it's clarity. Elite investors don't take fewer risks. They take smarter risks because they see the storm before it arrives. They make bold moves, backed by risk armor. They take leaps, with a parachute packed by experts. The real power behind billion-dollar decisions isn't luck, or genius, or boldness. It's structure, it's clarity, it's risk consulting. This is Investor School, where capital grows, because risk is respected.